everyone, and welcome back to Financial Podcast. I'm your host, Olivia, and today we're diving into a fascinating and perhaps paradoxical story unfolding in the world of high finance and digital platforms. But before we get started, if you find our discussions insightful and helpful, please take a moment to subscribe to the channel and hit that like button. Your support helps us bring you more in-depth analysis like this every week. Now, on to the news. OnlyFans, the platform widely known for its adult content, is reportedly nearing an $8 billion deal to be sold. The prospective buyer is a consortium led by the Los Angeles-based investment firm Forest Road Company, and they are said to be in advanced negotiations with OnlyFans' parent company, Phoenix International Limited. Sources close to the deal suggest an agreement could be reached within weeks. However, alternative paths, including a potential IPO, reportedly remain on the table. This potential sale figure of around $8 billion has certainly sent ripples through both Wall Street and Silicon Valley. OnlyFans presents a rather unique situation in the modern digital business landscape. On one hand, it boasts staggering financial performance. For the fiscal year ending November 2023, the platform generated $6.6 billion in revenue, a significant jump from $375 million in 2020. OnlyFans' own revenue, separate from the total money flowing through the platform, increased from $1.09 billion in 2022 to $1.31 billion in 2023. The company's profit reached $485.5 million in 2023, up from $403.7 million in 2022. This represents an approximately 19.9% increase in revenue from 2022 to 2023. OnlyFans takes a 20% commission from its content creators. Its business model includes generating revenue from subscriptions, 41%, and add-on services like pay-per-view content and live streams, 59%. The platform employs around 40 people. It has achieved what one fintech analyst described as unprecedented unit economics, including negative working capital, creator-driven acquisition with near zero customer acquisition cost, and EBITDA margins exceeding 50%. The financial profile is, in essence, described as perfect. On the other hand, despite this spectacular financial performance, the platform faces significant institutional hesitancy. The primary reason for this reluctance is its strong association with adult content. Leonid Radvinsky, the current owner, who acquired the platform in 2019 from founder Tim Stokely and his family, has reportedly struggled to find buyers willing to overlook this aspect. Radvinsky, who is a 43-year-old computer programmer and immigrated to the U.S. from Ukraine as a child, has seen his personal net worth reach an estimated $3.8 billion, largely due to OnlyFans' performance, particularly during the pandemic. He collected $472 million in dividends from OnlyFans in the fiscal year ending November 2023. Between 2021 and 2023, his total dividends from Phoenix International surpassed $1 billion. In 2025 alone, he reportedly paid himself a total of $631 million. The reported $8 billion valuation being discussed represents a significant premium compared to typical valuations in the adult content space. Industry insiders note that adult content businesses typically have valuations capped at 3 to 5 times their EBITDA. For context, when MindGeek, the owner of Pornhub, went through a distressed sale process in 2023, bids reportedly valued that company at just 3 to 5 times EBITDA, less than half the multiple being considered for OnlyFans. The Forest Road Consortium is reportedly looking at a multiple closer to 10 to 12 times estimated 2024 EBITDA. This suggests they are pricing in a strategic transformation of the platform that has not yet occurred. Financial analysts believe that any deal at the proposed $8 billion price point would likely incorporate significant risk mitigation mechanisms. This could include tying at least 30% of the consideration to future performance or regulatory milestones. Alternative structures like synthetic royalties or preferred securities with high coupons and conversion options might be used instead of a straightforward equity purchase. These financial engineering approaches highlight the core tension of this deal: how to value an asset with strong economics but uniquely high regulatory and reputational risks. The timing of the potential sale coincides with an intensifying regulatory environment across multiple continents that poses a threat to OnlyFans' core business model. In the UK, the communications regulator, Ofcom, recently levied its first fine against the platform, potentially setting a precedent for other jurisdictions. The European Union's Digital Services Act, which became effective in February, has made age verification a statutory requirement with potential significant penalties for noncompliance. Experts note that the regulatory landscape is shifting from reactive to proactive enforcement, turning what was once a relatively permissive environment for user-generated content platforms into a complex situation involving verification requirements, liability exposure, and potential payment processing barriers. In the United States, several states, including Texas, Louisiana, and Utah, have enacted laws requiring government-issued ID verification for adult content consumption, with legal challenges pending before the Supreme Court. Sweden has gone even further, with legislation set to take effect in July that criminalizes certain paid performances common on the platform. Perhaps the most significant concern for potential buyers is the platform's vulnerability to disruptions in payment processing. A whistleblower complaint in January, mentioning major card networks in allegations related to child sexual abuse material, has intensified scrutiny on how financial institutions handle high-risk merchant category codes. Experts warn that payment rails represent an existential risk to this business model. Adult content platforms already face transaction fees exceeding 10%, much higher than mainstream tech businesses. If card associations tighten restrictions further due to regulatory pressure, the entire economic structure could collapse quickly. While Visa and MasterCard currently process OnlyFans payments, an industry source cautioned that this could change abruptly. OnlyFans CEO, Kylie Blair, has stated the platform is working to prevent underage users from creating or consuming content, noting that similar risks exist for general social media platforms. To justify the proposed valuation, Forest Road would likely need OnlyFans to expand beyond adult content while retaining its creator-centric model. The platform's underlying technology, which manages subscriptions, direct messaging, and monetization for its large base of creators and subscribers, could potentially be applied to other content areas like fitness, education, or music. However, achieving such a pivot would require overcoming the platform's established brand identity. Some experts are skeptical, pointing out that this involves paying a premium for a hypothetical mainstream transformation, and that competing platforms like Patreon don't carry the same baggage and trade at lower multiples relative to their growth rates. OnlyFans was originally launched in 2016, targeting influencers and musicians, but the platform saw its popularity surge after Radvinsky lifted a ban on adult content a year later, particularly during the COVID-19. In 2021, there was a controversial attempt to ban sexually explicit material under pressure from financial institutions, but this decision was reversed within days following creator backlash. The challenges faced by OnlyFans are not unique in the adult content industry. Pornhub, for example, was on the market for years before being acquired in 2023 by Ethical Capital Partners, in a deal reportedly well below the $1 billion mark. Private equity firms with ethical mandates and mainstream media companies generally avoid adult content ventures, significantly limiting the pool of potential buyers. Companies like Playboy, despite going public, now trade at a fraction of their previous value. Past actions by Visa and MasterCard severing ties with Pornhub over allegations of illegal content illustrate the potential for payment processor issues to impact the business. OnlyFans currently relies heavily on Section 230 of the U.S. Communications Decency Act, which provides platforms with liability protection for user-generated content. However, legal experts suggest that a lack of oversight could be interpreted as willful ignorance, potentially eroding these protections as regulators increase scrutiny. The potential sale outcome will have implications beyond OnlyFans' immediate stakeholders. Payment processors, especially those developing alternative payment rails, could see opportunities if OnlyFans seeks to move away from traditional card networks. Companies specializing in content moderation technology and age verification systems also stand to benefit as regulatory requirements become stricter. For Radvinsky, who acquired the platform in 2019, the deal could represent the culmination of a very lucrative investment. His return, even with an adult content discount, would rank among the most successful digital media investments of the past decade. Forest Road faces the challenge of justifying an unprecedented valuation for a business category traditionally viewed with skepticism by institutional capital. Their willingness to proceed at the reported price point suggests strong confidence in their ability to navigate regulatory hurdles or a deal structure that substantially mitigates downside risk. As one investment banker put it, this deal is less about just buying the platform and more about buying a thesis that adult content can be repackaged for institutional investment without losing the economic engine that made it valuable. This is seen as a high-risk maneuver with little precedent for success. OnlyFans has approximately 4 million content creators serving a global subscriber base of 300 million users. As of 2025, there are over 3.5 million active creators on the platform. The total number of submitted creator accounts is over 10.5 million, but only about 36% of submitted creator-only accounts were approved in 2025. The number of creators grew by 29.4% from 2022 to 2023. The largest yearly growth was from 2019 to 2020 at 365.1%. The average age of creators is around 29, with most being between 20 and 40. Gen Z and millennials make up the majority of creators. The United States has the highest number of creators, with 1.1 million, followed by the UK, 280,000, and Canada, 175,000. California, Florida, and Texas account for nearly 29% of U.S. creators. Approximately 84% of OnlyFans creators identify as female. Female creators, on average, reportedly earn 78% more than male creators. About 60% of creators in a 2021 survey had not chosen to monetize their content, and less than 10% reported over $10,000 from their content that year. Top earners in 2021 were estimated to make millions per month. As of late 2023, there were over 305 million OnlyFans user accounts, a 27.73% growth from 2022. The ratio of fans to creators is about 74 to 1. OnlyFans users are predominantly male, 78.9%, while 21.1% are female. The largest age group of users is 25 to 34 years old, 35.78%, followed by 18 to 24-year-olds, 25.54%. About 89.5% of OnlyFans users are reportedly married. The racial breakdown of users is approximately 68.9% white, 18% Black, 6.7% Hispanic/Latinx, 3.5% Asian/Asian American, 1.7% American Indian/Alaskan Native, and 1.2% Other. On average, a user spends $20 per month on the platform. 2/3 of the company's $1.3 billion revenue in 2023, about $863 million, came from U.S. customers. The U.S. also accounts for the largest share of total traffic to the site, nearly 48%. As of 2025, the site receives over 252 million visits globally per month. The coming weeks will determine if this financial paradox can be resolved through creative deal-making, or if the gap between OnlyFans' impressive financial performance and its acceptability to institutional investors proves too wide to bridge. We'll be keeping a close eye on this developing story. It's a prime example of how financial markets grapple with businesses that challenge traditional norms. And as we wrap up today's episode, I want to remind you again to subscribe to the Financial Podcast channel and give this video a thumbs up if you found it informative. Your engagement is invaluable and helps us continue to produce content like this. Thank you for tuning in to Financial Podcast. I'm Olivia, and I look forward to discussing the latest in finance with you next time.